This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. These are the top stories this hour. Asian markets are set for a positive open as traders bet on continued market volatility. Investors are awaiting a US inflation print that could be key to next month's Fed rate decision. It's a big week ahead for tech earnings too, with Tencent, Alibaba and JD.com set to give a snapshot of China's economic and consumer sentiment. And the head of India's market regulator denies claims by Hindenburg research of conflicts of interest over the Adani group.
And of course, after all of the market gyrations last week, I can't believe, Heidi, that we're still bracing for more volatility this week. We're talking about the U.S. CPI print that investors are watching very closely because options trading is now showing a possible move on the S&P 500 of more than 1%. And of course, this coming at a time when the VIX is now hovering back around those 20 levels after spiking to 65 on Monday. We saw that really panic selling earlier in the week just for the S&P 500 to finish almost flat.
Yeah, and of course, so much comes down to what we see from that CPI reading, right? Because every single piece of data, particularly when it comes to price pressures, are going to sort of intensify the path forward as expected by markets on what the Fed does. Take a look at the latest survey when it comes to expectations from the Federal Reserve and what that path ahead looks like, because we do have really the idea that they're kind of really holding firm, right? Rejecting these calls for jumbo rate cuts in this Economist survey. The intermediate interest rate cut is seen as now being extremely unlikely, particularly as we're now sort of through the depths of the market volatility and the chaos that we had just a few sessions ago. This Bloomberg survey of economists really reflecting the typical sense of caution that we do get from the Fed. Nearly 4/5 of economists that we spoke to predicting that the Fed will just trim rates to the range of 5% to 5.25% at that September 17-18 meeting. Most of the rest predicting a larger reduction, but that median forecast showing just 10% odds for a rare move to move on rates prior to the scheduled gathering. And so with markets looking, at least for now, calmer, that does seem to be kind of the reality check in terms of Fed expectations, Shery.
I mean, last week we had those dizzying moves in global markets, right? Especially with treasuries as well, with the 10-year yield plunging. We're back almost to levels where we started the week as well. As you said, it's all about pricing in the Fed rate cut, right? But take a look at how we're setting up with U.S. futures, because we're really not doing much at the moment. And this, of course, after those losses of about 3% for the S&P 500 on Monday, just to claw back everything. And what an incredible comeback, because the last two sessions were the best two-day gains of the year. But still, when it comes to market volatility, we'll continue to watch, of course, eco data, including those inflation numbers. Take a look at what's happening across Asia right now, because Japan is away on holidays today, but we continue to watch the Japanese yen, which is now again on a weakening trend against the U.S. dollar. We have gotten many different calls when it comes to the yen carry trade. BNY, the latest, saying that we still have a ways to go when it comes to the unwinding of the yen carry trade, and that we could see the yen closer to that 100 level against the U.S. dollar over time. In the meantime, we're watching Sydney futures seeing an upside of 0.8% before the market opens. And of course, we have plenty of data coming out of China this week as well, including interest rate decisions, not to mention activity numbers. And we have a rate decision from the RBNZ, a likely cut expected. Our next guest is among those bracing for market volatility. Joining us now from Singapore is Vishnu Varathan, head of economics and strategy at Mizuho Bank. Vishnu, great to have you back. You've talked about this conspiracy of risks when it comes to the markets right now. What are you watching in terms of that yen unwind and potentially even a yuan unwind?
Well, good morning, Shery. So one of those things that we're watching is for the yen, I think arguably you can say that the BOJ tried to stopgap the potential for further volatility, saying that they won't take further rate hikes if their markets are unstable. That does help to somewhat placate the initial volatility that's triggered, on mounting expectations of further rate hikes by the BOJ. But that's only one part of the equation. The other part of the equation, of course, is what the Fed may do. And as we found out post-NFP, if you get expectations of upsized and more abrupt Fed cuts, then there is always going to be that huge risk of further yen carry unwind, given the concentration of risks in yen carry, which has somewhat abated, but has not been completely abolished yet. And so that's what we're watching. We're watching for volatility a lot more now swinging to the side of the Fed and incoming US data and arguably hypersensitivity around it. I mean, it'll be remiss of me not to mention US elections as well. So there's a certain unknown quotient in that kind of uncertainty because of just comments or market speculation of what could happen with the yen or the yuan, both of which Donald Trump has mentioned. On the renminbi, of course, we also think that we've seen high correlation of an unwind and the renminbi strengthening alongside the yen. But the other bigger point that we want to make is yen volatility and yen carry unwind. We think it's a far greater risk because of diametrically opposed policies.
Yeah, tell us a little bit more about the yuan, because when there was all this volatility with the yen carry trade, people were pointing to a potential squeeze on the Chinese renminbi. We do have eco data coming out this week. We have decisions on interest rates as well from the PBOC and a potential change when it comes to the rate corridor coming from policymakers in China. What are the most important factors for you?
I mean, I think for us, policy response continues to be the most important factor. I mean, arguably one reason why markets are all obsessed with the data is there's an implicit expectation that they are looking for policy response if you see weak spots of data. Otherwise, the stimulus rolled out so far hasn't really been groundbreaking, even if it's been welcome and incrementally helpful for China's economy. So right now we are on the brink of saying, the 5% target is going to be hard to achieve along the current momentum. More worryingly, the medium term doesn't look like it can rise comfortably above 4.5%. So it's going to be stuck 4 to 4.5, if that. The carry trades in the renminbi, though, are quite a different story. I think it's one thing to move in a huge correlation with the yen, but quite another to become a standalone carry trade, because I think the fundamentals are quite different. Besides, the PBOC probably has to ease further, not tighten, unlike the BOJ. And we've got the upsized risks adverse risks to renminbi, depending on what kind of US-China tensions mount. So there's a certain unknown around it. And that implicit unknown means that renminbi is not the best tool to conduct carry trades in.
And Vish, to be clear, I think the risk you make, the case that you make, is that the risk is not really the unwinding of CNY-funded carry trades. It's the sort of contagion of broader risk off across Asian currencies. How closely correlated is the yuan at this point, particularly across the EM complex?
I mean, that's certainly right, because we really think, as you pointed out, our big thought is the far bigger risk to this region and Asian currencies is that the renminbi weakens, not strengthens. So the source of shocks would be from a starkly weaker renminbi. Those risks are I think, magnified by two components. One is the economy, I think, continues to suffer a confidence crisis. So it's not just about whether we make the 5% or not. But the chronic lack of confidence means that we continue to see capital leakage despite a strong current account surplus. So that undermines the currency. Over and above that, we also have got the geopolitical tensions which are not helping the renminbi. So the renminbi, despite pockets of respite, continues to be under pressure through this process. And the Fed rate cuts alone might not assuage it. I think categorically. So that's our risk. And the correlations we see in the region vary across the currencies, but are to the tune of, say, 0.8. And so there's an 80% correlation between the Chinese currency and other Asian currencies. And the reasons are easy to see. I mean, the trade linkages, supply chain linkages, as well as the financial linkages means that the longer term gaining from a China plus one strategy for now is going to be drowned out by the immediate risks that come about from trade tensions being ratcheted higher.
Beijing seems to have a level of comfort in terms of trying to sort of manage the downside risks and being realistic about what upside growth could be achieved, right? Do you think that this is a smart strategy, and how much does it potentially kind of feed into the longer term risk of a deflationary or stagflationary cycle or spiral for China? Is that a concern?
I mean, that's really one of those really deep questions that probably needs to sort itself out over the political cycles. But I think the point made on the potential for stagflation type of effects to come through remains a clear and present danger, because if geopolitical risks are heightened enough, then costs get ratcheted up despite demand being somewhat more suppressed. So it's not outright stagflation, but it's the stagflation type of condition where China's growth could dwindle a little bit more, yet the cost, despite the deflation type of effects from demand side, you could find supply side costs remaining high under certain circumstances. So for us, we look at it two ways. One is onshore in China, the deflation type of dynamics continue to be the bigger risk. So there's going to be a lack of demand, and that's really, alongside the excess capacity, that's going to drag down a lot of the sentiments, and there's a potential for a pernicious loop here. Whereas when you translate that into the global trade picture, because of geopolitics, tariffs, security stockpiling, so on and so forth, these things could keep costs high. So you don't get the benefit of the cost reduction from excess capacity, but then you do get the tyranny of demand suppression. So that risk is a particular risk that's accentuated by the geopolitical scenario that we have.
Vish, do stay with us. Vishnu Varathan, who's the head of economics and strategy at Mizuho Bank, is staying along with us to talk a little bit more. And coming up on the Asia trade, hear why OCBC thinks investors looking for a quick fix to the recent market turbulence may be expecting too much. Plus, China is in focus, with Goldman Sachs as investors await the PBOC's rate decision and that activity data. This is Bloomberg. Take a look at how we're setting up when it comes to the start of this trading week. Of course, it is a public holiday in Japan, so a little bit of a holiday-thinned lead as we get into trading here in Asia. But Sydney futures looking pretty much like a pop at the open, 0.8%. It is a bit mixed though. Nikkei futures looking a little bit higher, 0.6%, despite of course no cash trading today, and S&P futures looking a little bit flat at the moment. A lot of focus on those key US data prints as well as some China data as well. Let's bring back Vishnu Varathan, who's the head of economics and strategy at Mizuho Bank. So Vish, as we'll take a little bit of a breather after the week and a bit that was. What's really been the wash up for you in terms of new opportunities and perhaps new areas where you want to be looking at some caution and perhaps some hedging?
I mean, that's certainly the sentiment as well. I mean, the last Monday, so just last week, the sense was that the risk off was overdone and markets were overreacting. But the trouble is, when everyone's overreacting, you're not going to be the first calm head to say, let's do this, because it's still a case of so-called falling knives. Whereas now I think markets will probably get a lot more focused on two things. One is they're probably going to start looking at the underlying valuations and see what's attractive, what's moved to places, prices that they could hold for the longer term, and that's certainly one part of the equation. But the other is also that markets want to or will start to price is that there needs to be a rethink in terms of risk premium. So the two aspects of it that markets probably will now start to price in a bit more seriously might be the aspect of credit risk premium. So that's to say specific risk that's associated with whether you're talking about it at a corporate level, a sovereign level, and those things start coming through. And the other is term premium, because if the Fed does indeed get into a rate cut cycle that's deeper and faster than anticipated, whilst rates across the curve might be falling rapidly, there is always going to be a far greater chance that you get a much steeper yield curve. And that steeper yield curve perhaps hasn't sufficiently percolated through many of the markets. And high-yielding assets in particular in this adjustment process will probably take a step back because of the steeper yield curve, reordering the pricing for high-yielding assets as well. So I think we are moving into a phase where markets get more cautious about higher-yielding assets.
Will that be the case across Japanese equities as well? I mean, the market is away on holiday today, but we saw a little bit of rotation given the market gyrations last week. So what are you watching out for in the Japanese equity markets once they come back online tomorrow?
I think there's still a case to be structurally positive on the Japanese equity markets. And one thing to bear in mind here is that the BOJ's response function will also be quite different to what markets had priced in just before the sell-off. I mean, a good reason for that is the so-called Japanese equity premium that had dissipated thanks to the support policies of the BOJ. A lot of that was eroded over that sell-off. So the one thing that comes across is the BOJ is a lot more circumspect about tightening to the point where you start undoing the gains and the disadvantages in the market, and how tightly linked the yen and equities are. And I also think that one of the basic assumptions of the BOJ was that the Fed is going to take a very, very gradual glide path down. That has needed some serious rethink right now. And for that reason as well, I think the BOJ will end up moving a lot more gradually and a lot more cautiously than maybe currently priced in, even after the assurances of the BOJ. So I think there's scope for support to come through, but there's a little bit of volatility shakedown that markets cannot look past, particularly through the summer lull. So we want to be cautious now, but there are opportunities that will re-emerge because policy response will start to change.
Does some of that caution mean that you'd be hopping back into treasuries? Because it seems like that inverse correlation is finally back in favour. Is that sort of the preferred hedge, or do you look more to EMs for better yield?
I think the treasuries certainly make a good hedge, particularly given where rates are. At the very least, the carry looks attractive. And the rate cut prospects, I think, boost that from the price angle. But that's going to bear some volatility. And to be in the EM space, one of two things must happen. Either you take a relative positioning so that some of that risks associated with the US rates and the volatility that it could cause are hedged, or in the EM space, there needs to be a bit more cherry picking. And I think it comes down to two things. One is you can see where fiscal policy has become a lot more supportive of the economy. And by that, I mean there's sufficient consolidation without wrecking the economy. And also, it's better to get into not the extreme high yielders, but the fairly low yielders where central banks may not hasten to cut rates in tandem with the Fed, because that could heighten volatility in the initial phase rather than providing comfort for the economy.
We do have a rate decision coming up this week as well in New Zealand, the expectation for a likely cut. But Vishnu, Varathan, good to have you with us, Head of Economics and Strategy at Mizuho Bank on this early Monday morning across Asia. We do have more ahead on the Asia trade. This is Bloomberg.
We're watching the latest in the Middle East as well. This, as we saw, a deadly Israeli strike on Gaza City drew international condemnation. Israel saying that it was aimed at a Hamas command and control centre. Let's get more from Michael Heath, who's covering the latest on this story. But of course, the problem was that this was also a school and an adjacent mosque.
Yeah, I mean, it's drawn a lot of international condemnation, and again, you know, it's the age-old story of conducting a war in a highly built-up area. I mean, Israel's quite adamant that it was targeting militants there, and that potentially some quite senior figures were hit in the attack. But the international condemnation and the local response is that there were a lot of civilians there as well. So, I mean, it sort of looks like this classic situation of Hamas potentially putting military objectives in those sort of sensitive areas, and Israel deciding that it'll just take the opprobrium in order to tackle these guys. But yeah, I mean, it's just a horrible, horrible outcome. I mean, 100 people or so who've been killed in this. So yeah, I mean, just more of the same, unfortunately, there. Yeah, and it's sort of hard to see how that, you know, where it sort of evolves from there either. As Israel, as the areas limit and Hamas is hiding more and more of its people, civilians are the best place to do that, obviously, as well.
We've also got an interesting story at how Israel's been bolstering its various infrastructure in preparation for a potential retaliatory attack from Iran or one of its proxies. Yeah,
I mean, it's sort of a real war of nerves at the moment because there hasn't. There's been no moves yet from Hezbollah or Iran, and it's really uncertain how that's going to unfold. But Israel's been trying to ensure its electricity keeps going, and it's a high-tech nation, Israel, and behind the electricity is to try and keep mobile services going, because obviously in any attack, in any war, information is just priceless in terms of keeping yourself alive and keeping yourself safe. So they've done a lot of work in trying to reinforce that infrastructure and ensure that in the event of a really significant attack that they can keep services sort of going there and keep people informed.
Yeah, and we're in the meantime hearing reports of these small incremental moves that Iran's missile unit is conducting drills near the Iraqi border. What do we know?
Yeah, I mean, it is only a small report at this stage, Shery, but yeah, Iran has been doing some missile tests, and obviously in this environment of Israel waiting for a retaliation for the killing of Hamas's political leader in Tehran. Everyone's on sort of high alert on this, and as sort of I mentioned, it is a war of nerves on when this might happen. I mean, Iran's foreign minister has said that there will be a response. There's sort of a bit of an inflection point coming up. There's talks on August 15th looking at potentially trying to get a truce finally over the line between Israel and Hamas. Whether Iran or Hezbollah would do something before that, or whether they'd rather wait until after that, is sort of a question. There's also been reports that Israeli officials think that that's sort of irrelevant to them, that an attack could come in the next couple of days. So, yeah, we're really sort of waiting on edge here.
Bloomberg's Mike Heath there, and of course we continue to watch oil markets as global energy markets continue to be on edge, waiting for these further developments if they do come. We have seen sort of the demand side of the equation weigh a little bit heavier here, with oil of course seeing that weekly gain, that focus, not just of course on these events in the Middle East, but of course on the broader sort of a huge amount of volatility that we've seen across equity markets there as well. So going into this new week will be quite interesting, particularly as we've had sort of some more data seeing the slowdown in oil refiners as well. So that's sort of just adding to that global glut concern. More ahead on the Asia trade. This is Bloomberg.
There's been a lot of speculation about what economic policy would look like after the U.S. election. Democratic nominee Kamala Harris says she would respect the Fed's independence if elected president in November.
The Fed is an independent entity, and as president, I would never interfere in the decisions that the Fed makes.
Harris is, of course, looking to draw a contrast with Republican nominee Donald Trump, who says presidents should have some say over interest rates and monetary policy. Former Treasury Secretary Larry Summers also told us he disagrees with Trump.
The reason why countries all over the world, this isn't just an American thing, but countries essentially all over the world have moved to independent central banks, is that they recognize a profound conflict of interest.
We also asked Summers whether the Fed needs to make an emergency rate cut after recent weak economic data. Take a listen.
On current facts, given that there has been some recovery, given that volatility has come way down, we're not out of the woods. You can't be certain. The Fed certainly needs to be watching carefully, but I think an emergency response would be lurching, panicked, overheated, and counterproductive on current facts, which doesn't mean that the Fed shouldn't be watching very closely. Before they have another decision to make in September, there's going to be a lot more data that's going to come in. And I think they should make clear that they're going to be watching all that data and they're going to make a decision reflecting the need to balance the concern of making sure that we have stopped inflation with the concern of maximizing employment. And I think they need to not be pressured into specificity of a kind that is impossible. And when this Federal Reserve has made mistakes, the mistakes have been of overconfidence and overly firm statements that prove to be unwarranted in light of the data as it evolved. And so I think they just need to say they're watching carefully and they'll do what's appropriate. But certainly no move between meetings. It may be that a 50 basis point cut is appropriate. We just don't know. Anything's possible. The huge excitement about 75 basis point cuts that followed immediately after Monday, I didn't think any of that was warranted at that early stage.
Larry, let me pick up on one of the things you mentioned, which was volatility. The VIX really did spike up to, I think, over 60, maybe the highest it had been since the pandemic first hit. How much attention should the Fed pay to that volatility index, what it might be telling us about how the markets are functioning?
I actually think that the SEC and the relevant exchanges may want to pay a bit of attention. My understanding is that because there are some illiquid instruments that go into the calculation of the VIX had a somewhat artificial movement on Monday, that if one looks at the VIX futures, which are a somewhat different instrument, the movements were much, much less dramatic. So I certainly had my attention caught by the VIX early in the day on Monday, but as I have looked into it, I think you were learning more about issues around liquidity in the options markets than you were about some profound reassessment of the American economy.
Former US Treasury Secretary Larry Summers speaking with David Weston on Bloomberg Wall Street Week. Take a look at Treasury futures at the moment. We've seen kind of this return of the long ago, it feels like, trade, right? The inverse correlation between bonds and equities seem to be making a bit of a comeback here as a hedge after, of course, the sort of ravaging that we've seen across risk assets over the past week or so. We do see a little bit more of a semblance of calm, though, but we're still, of course, watching to see that dynamic between the Fed and the BOJ. One former BOJ board member ruling out another rate hike by the central bank this year. Makoto Sakurai says that's due to the market turmoil following its recent hike. Garfield Reynolds, who leads our Markets Live Asia coverage, joins us now for more. So we're a little bit calmer. Where's volatility at? And clearly, as you kind of hear from some of these market participants and observers, there's a real sense of caution now. Yeah,
although whether markets have been scared enough, remains to be seen. We've got people saying, "Oh, look, Japanese stocks are cheap. Time to pile back in." One of the difficulties, we are still pretty elevated on the VIX. It's above 20. It closed above 20 at the end of last week, so that is still higher than it has been for a long time on a closing basis, outside of the occasional spurt higher. currency volatility, naturally enough, with all this unwind of the carry trade, is very elevated relative to where it has been going. And in a lot of ways, that's sort of a correction from what looked like too low levels of volatility for currencies. You're in a year where you are going backwards and forwards, but eventually getting to Fed rate cuts, which means presumably at least a slowing US economy, if not a recession. So we had some very low levels of volatility in currencies. That didn't make a lot of sense, in particular because we also have the ongoing concerns about the Middle East. We've got a war in Europe, and we've got the US presidential election, which is definitely still very much on the table as something that could cause a lot of volatility, in particular because you look at what's gone on with both betting markets and polling markets, where a month ago everybody was saying, okay, it's Trump 2.0, prepare for Trump trades. Now things look like they're trending. People have started the trend towards the idea that the Democrats will win, but really, honestly, it's back to where it was 2-3 months ago. It's a coin toss. So that's a lot of potential volatility there as well. So with all of that going on, it's hard to see things getting too calm. We should also be seeing just a general reduction in risk appetite from the point of view of your portfolio managers. A lot of them will have adjusted lower how much risk they're willing to take on at any one time because of the aftershocks from what happened last week.
Is it also a coin toss when it comes to the Japanese yen, whether it goes up or down against the U.S. dollar from here on out? Because you mentioned the U.S. elections, and we know the Trump presidency actually led to a stronger U.S. dollar, and we're expecting weaker Japanese yen. At the same time, we have the yen weakening again. I'm also seeing calls from BNY saying that we could see 100 per dollar over time for the yen. I really don't know where to put the Japanese currency at this point.
Well, the skew for the Japanese yen should be for it to get stronger from here, even if even the former BOJ member is right and they don't hike again this year. They're still reducing their bond purchases. They've still laid out a plan to hike rates, and at least theoretically from the BOJ, if they don't hike rates, it's got to be because the economy doesn't do what they expect it to do. If their recent outlook proves to be accurate, they should be hiking rates again this year and certainly into next year. And on the flip side, again, the Fed has been pushing back against the idea of jumbo cuts and even of rapid cuts, but a rate cut is still on the table for September, and in fact, probably more than one rate cut this year, definitely multiple rate cuts next year. So the rate differentials are telling you the yen should be stronger than where it is. The big question for everybody is how fast does it move? The actual levels it gets to matter a lot less than how rapidly it moves. And even after it actually ended last week, little changed, it's still risen pretty fast in the last month or so. And that's part of what spread so much pain for Japanese stocks, for carry traders. So the hope would be that the yen, if it is going to keep on gaining, and in a lot of ways that's kind of the path of least resistance and therefore perhaps the path of least pain, or at least volatility, if it grinds higher in the same way, for a lot of the last year or so when the yen ground lower, that was okay. It was when it got to extremes or when the moves got rapid, that's when it caused problems.
Catherine Reynolds, who leads our Markets Live Asia coverage there. And Shery, as Garth mentioned, so much of this, of course, being centred around at what point we're at when it comes to the carry trade unwind. And I guess the point is that even though we've sort of reached a semblance of calm, right, after just a chaos, in particular of last Monday and the days that followed, there is still this kind of question and concern as to how much of this is still potentially left to play out in the weeks to come. How much volatility could we continue to see rippling through markets in the weeks ahead? And the question mark about, should an alarm kind of been raised about how much leverage we've seen built up around Japan as the BOJ kept pumping out cash despite the post-pandemic inflation surge, and the way that we saw, of course, these carry trade hotspots really see that vulnerability with the likes of, the Nasdaq 100 off those record highs and just these mounting worries as well, right? And the question, I guess, also is where do we see the vulnerabilities across asset classes most vulnerable to the yen carry trade continuing to unwind? Our analysis shows us it's really these high beta assets, the likes of Bitcoin, US stocks. They, of course, rose during periods of aggressive yen selling between January 2022 about June 2024. That's according to our senior Japan economist for Bloomberg Economics, Tara Kimura, also really pointing out that these kind of deteriorating economic conditions in the US, how you make of them, I guess, how much of the deteriorating, we'll get a little bit more with the CPI numbers this week, but also the expected response from the Fed. Really, these drivers of yen buying, we could see further unwinding by investors on those short positions on the yen in the weeks and months to come.
And you said it, right? I mean, it's all this risk and uncertainty that has led to that bond rally. You alluded to the fact that bonds are now back as a hedge after failing investors for years. And right now we are seeing the 10-year yield after that plunge following the U.S. unemployment numbers coming back to levels we were at before. But I think the most important thing right now is that really fixed income sort of seems to have returned to that stabilizing force when it comes to hedging risk out there. You are looking right now at that traditional inverse relationship between bonds and stocks, which really had held firm for the first couple of decades of this century, but not so much recently. And you can see that inverse relationship again becoming very strong, the strongest since we saw the banking turmoil in the U.S. last week. So we'll continue to watch, especially those 60-40 portfolios and how they do from here on out. More ahead on the Asia trade. This is Bloomberg.
Big week ahead for Chinese tech earnings. Of course, Alibaba, Tencent, JD.com, all due to report. Just giving us a fresh snapshot of the economic and consumer sentiment levels that we see in China. For more, let's bring our reporter, Annabelle Jewellers. So buybacks could be a major theme, Belle.
Yeah, that's right, Heidi. They've actually already been a major theme for Chinese tech companies, but the programs that are in place could be expanded in the quarter ahead. Some quite compelling reasons for that as well. Firstly, we've seen the balance sheets of Chinese tech companies. Those are looking strong. We know names like Alibaba and Tencent, they're focused on boosting shareholder returns, and valuations are cheap as well, especially when you compare back to an historical basis. So as our Bloomberg intelligence team points out, these are sort of the conditions that a perfect trifecta, essentially, for share repurchases to take place. But like I said, the programs have already been in existence, and even over the course of this year alone, we've seen Tencent and Alibaba buying back more stock compared to all of 2023.
And Belle, the great thing about these tech giants, especially those e-commerce giants, is that we're going to get clues about the state of the broader economy, especially consumption in China.
Yeah, it certainly gives us a window into how China's economy is faring, and here it definitely could have a bearing, but show up in a few different ways. So Tencent, for instance, it's the first one to be reporting on Wednesday, and the divisions we're going to be looking at in particular are advertising, fintech and business services. So those two divisions make up about 50% of Tencent sales. They're the ones that Bloomberg Intelligence has highlighted as being most at risk if the economy continues to decelerate. And as we've seen, as you say, Shery, really retail sales have been challenged in China. Even if we saw that slight pickup in consumer prices in July, that's giving a little bit of optimism. You can see in that chart there. That's the picture that really weighs on Alibaba and JD.com in particular. Those are reporting on Thursday, but they have been really pushing ahead with things like discounts to try and lure customers inside China, especially when you've got competitors like PDD that have been very aggressive. That weighs on margins. And then as well, there's that cost of acquisition for consumers outside of China, for names like Alibaba, for instance, that's coming up against Shan, Temu. Again, all of these things hit the bottom line.
Annabelle Jewelers there with the latest on what we can expect from those giant tech earnings from Chinese companies. And of course, at the center of that slowdown in the Chinese economy, the property sector. Chinese developer Kaisa will square off with creditors on Monday, facing a Hong Kong court that may be open to issuing a wind-up order. For more, we're joined by our China correspondent, Min Lo. Min, so it's been 2 years since a bond default. Kaisa has still not publicly presented a debt restructuring plan. What's going on?
Yeah, that's right. So it's really a make or break week for Kaisa because the judge had previously said that they really have no excuse this time if they don't make any progress, which means that if Kaisa doesn't come up with a debt restructuring proposal this time, the court could order them to sell their assets to repay creditors. And if that happens, this will be the second largest developer to face liquidation after China Evergrande, and that will be quite a big blow to the property sector, which is still struggling to find its legs, even with the support measures from the government so far. Kaisa has over $12 billion in offshore debt, one of the largest of its kind. And in an October hearing, a lawyer had said that the debt recovery ratio, if it faces liquidation, is quite low at only 5%. The expectations is not very high, given that its dollar notes, you can see on the screens there, is trading on cents on the dollar, and that means even if it comes up with some sort of debt to equity restructuring plan, its small market cap is going to make it quite challenging to really absorb a meaningful proportion of its debt.
Times China, this is a Guangzhou-based developer, is also facing a wind-up hearing today. What are the expectations there?
Yes, so Times China case is a little bit more optimistic because the scale of their debt is much smaller, just $260 million that they owed after defaulting on $2 note back in January of 2023. This wind-up petition was filed by Hang Seng Bank in April, and we last reported that Times China has really been accelerating talks with its creditors since that petition was filed. As far as we know, they had come up with 3 options in their proposal, which is a combination of upfront payment, short-term notes, and ordinary shares in the company. Investors also have the option to receive mandatory convertible bonds and medium-term notes as well. So if Times China is able to show that it's making some form of meaningful progress in its debt restructuring plan, then they may be able to get an adjournment on this hearing.
Bloomberg's China correspondent Min Lo there with the latest. Taking a look at one of the other stories that we're tracking this hour, the chair of India's market regulator is strongly denying claims by Hindenburg Research of conflicts of interest related to the Adani Group. Hindenburg published a report on Saturday saying that the Manabhi Puri broker and her husband invested in offshore entities that were largely, allegedly, I should say, part of a fund structure in which billionaire Gautam Adani's brother Vishnu had also invested. Hindenburg says the investments were made 2 years before Brook was appointed to the Securities and Exchange Board of India. The couple calls the allegations baseless. More ahead on the Asia trade. This is Bloomberg.
Here are some of the stories that we're following at this hour. Ukraine's president says Russian troops have started a fire at an occupied nuclear power plant, calling on the world and the International Atomic Energy Agency to react. Volodymyr Zelensky said in a post on X late on Sunday that radiation levels were within a normal range. Earlier, Zelensky called on allies to allow Kiev to strike deep within Russian territory as Moscow hit back with missile strikes following last week's cross-border incursion by Ukrainian forces. Philippine President Ferdinand Marcos Jr. has blasted actions by China's Air Force against a Philippine plane over the South China Sea as unjustified, illegal, and reckless. That's after a video published by the Inquirer purportedly allegedly showing a Chinese plane dropping flares into the path of a Philippine Air Force patrol. The incident happened as the two sides are trying to ease maritime tensions. A new poll from the New York Times and Siena College gives Kamala Harris a 4 percentage point lead over Trump in the swing states of Wisconsin, Pennsylvania, and Michigan. It follows a campaign tour of crucial states by Harris and her running mate Tim Walz. However, the poll also found voters think Donald Trump would do a better job handling the economy and immigration. Heidi.
Shery, let's take a look at what you're watching when it comes to commodities in the week ahead. And of course, this has also been an asset class that's been really roiled by the broader risk-off sentiment and the market volatility. We did see some gains being held on to when it comes to oil in particular. This is, of course, as we continue to watch developments in the Middle East, pretty steady going at the moment. A little bit of downside for Brent after that weekly gain, the first since early July. The market's still really awaiting for any potential response from Iran to last month's assassination of that Hamas leader in Tehran. We're also watching gold prices at the moment there as well. We're seeing a little bit of downside, about 0.1%, Shery.
But also this coming at a time when we saw gold prices soar to record highs around mid-July, right, Heidi? Not surprising then that when it comes to those gold medals that athletes received at the Olympics this year might be worth the most they've ever been worth, because gold goes, of course, into those gold medals. We're talking about around $900 each, perhaps. Prices also substantially higher this year for silver, which also makes up at least 92.5% of the weight of gold medals.
And this year, of course, the medals also contain a small piece of the Eiffel Tower. That's been one of the special parts of this Olympics. Perhaps more lucrative than $900 worth of gold in those medals are some of the gifts that we've seen countries giving their winning athletes, right? Cash payouts, exemptions from military service, cows, chicken and mac and cheese for right. One athlete in the Philippines, amongst other things, Shery.
Yeah, I mean, what an incredible 2024 Paris Games it's been, right? I mean, we saw really icons like celebrity Snoop Dogg and Lady Gaga there making appearances. We'll have more. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after a dizzying week of global market gyrations. Heidi, we're still expecting more volatility this week. Options now pricing in a potential 1.2% move in either direction on the S&P 500 after U.S. CPI data.
Yeah, that CPI data is really keenly awaited because at the moment the sort of chances or expectations of an outsized or out-of-cycle move from the Fed are diminishing pretty quickly. But the question, Shery, is also where we see this carry trade unwind going from now, right? Some of that analysis from Bloomberg Economics suggesting that we could see further vulnerabilities ahead for the likes of U.S. equities and also asset classes like Bitcoin.
What a roller coaster ride it's been for the Japanese yen, right? Especially as that unwind of the carry trade also had an impact when it came to those tech stocks around the world, because we saw some of that unwinding. We had seen really borrowing in cheap yen going to some of those tech stocks, with the Philadelphia Semiconductor Index being very correlated with the Japanese yen. But of course, that will be a key metric that we'll be watching as South Korean markets come online, because they're this very tech-heavy market as well. Right? What we're also watching are those trade numbers for really an understanding of where global trade is going from here for South Korea as well. For the first 10 days of trade for the month of August, we're seeing exports rising 16.7% year on year. We have seen, of course, those semiconductor exports, tech exports from South Korea supporting the broader market sentiment across this economy. We are seeing the upside right now. The Korean won also holding at that 1365 level. When it comes to those chip exports for the first 10 days of this month is also a jump of 42.1% year on year. So we'll be watching those big chip names such as Samsung and SK Hynix in today's trading as well, especially since Japan is away on holidays. But take a look at what the Japanese yen is doing, because we continue to see the weakening trend after that incredible rally that we saw after the BOJ rate hike, after the weaker than expected U.S. jobs numbers. But right now we're we're again trading at those 147 level. BNY saying that we still have a ways to go when it comes to that carry trade unwind, that we could see the Japanese yen soaring to that 100 level against the US dollar over time, Heidi.
Yeah, take a look at how we're setting up when it comes to the start of trading this week and this morning here in Australia. And of course, it is a staggered start, so not too much of a move, but we are looking like we're going to see some cautious upside in this session. These stocks, of course, have been trading pretty close to record highs, even just sort of before the recent bout of market volatility, right? Taking a look at how we kind of finished in the last session, we did have that strong leadership from tech stocks in particular. So a lot will be hinging on what we see out of the big tech names in China and sort of broader developments for the Chinese economy, with the Chinese macro data in focus as well. We did see a loss of over 2%. That was the worst weekly loss for Australian equities since about April. We're seeing the Aussie dollar holding pretty steady at 65.69. We're also watching the gains when it comes to Australian bonds, really kind of following the trajectory we've seen in treasuries. Of course, that story has been revived as sort of the caution hedge, if you will, that inverse correlation between bonds and equities and treasuries in particular finally being revived in the wake of last week's volatility. We're seeing bond futures, though, looking pretty muted there when it comes to the US 10-year at least. Oil at the moment holding pretty steady after that first weekly gain since early July. Still watching those developments in the Middle East, as well as some of the supply side factors as well. The refining data suggesting that we might see some worsening of that broader glut situation. Let's get some views from our next guest, who says volatility continues to lurk in the background and could resurface intermittently. With us now is Vasu Menon, who's a Managing Director of Investment Strategy at OCBC Bank. And that's sort of part of the concern, right, Vasu, when it comes to particular how much further we have to go for the yen carry trade unwind. Do you expect to see this play out over the next few weeks and months? We head into then, of course, the political uncertainty into November. Is a higher degree of volatility just something that markets and investors should be really bracing for now?
Without a doubt. I think, the next coming weeks, coming months, you'll see the markets volatile for the reasons you so rightfully mentioned. I mean, we're still unclear as to yen carry trades have fully unwound. Yes, the yen has weakened now, and that has taken some pressure off the carry trades. But, the unwinding of carry trades, that is. But, it's possible that the yen could strengthen once again. We see the yen trading in the short term within the range of 140 to 150. But if the yen does strengthen towards the 140 level, you could see carry trades come back into play once again. Because if you look at the Bank of International Settlement data, I mean, Japanese financial institutions have lent almost US $1 trillion in yen to foreign borrowers, and some of it, of course, have gone into carry trades. So, it's a bit opaque. We're not sure how much more there is to go, but it's something that investors need to brace for in addition to the slew of economic data this week and in the coming weeks in the run-up to September 18 Fed meeting and, of course, the US election. So quite a lot happening in the next few weeks and months. And so without a doubt, there's going to be quite a bit of volatility in the markets and carry trades being one of the uncertainties that we have to deal with.
It's tempting to be opportunistic, right? But this is not the time yet for aggressive bottom fishing.
Yes, that's what we're telling our clients and our readers, because we feel that things are still playing out. The markets are nervous about the US economy, and you've got lots of economic data coming out this week. For example, you've got 3 Fed speakers speaking this week. And in the next 5 to 6 weeks, in the run-up to the September 18 Fed meeting, you do have quite a lot of data on tap. And then, of course, you've got the Jackson Hole summit that's going to take place on August 23rd, where Jerome Powell speaks, and then the US election. So, I think the markets are going to be very volatile, and I think investors don't want to fire all their bullets. They should use the volatility as an opportunity to accumulate on sharp pullbacks, because we're not negative in the medium term. We are quite cautious in the run-up to the end of this year. But 2025, we think that once we go past some of this, headwinds, the markets might look slightly better.
It was really interesting to see the gyrations, especially in the treasury space. Global bonds sort of becoming a hedge now again when it comes to market volatility. At the same time, we saw all of those moves being retraced as well. Is the key takeaway from what happened in the last few days the fact that perhaps in the near future, with this inverse correlation between bonds and global stocks again taking hold, that really it could be a meaningful hedge?
Perhaps, yes, without a doubt. I mean, we believe that, there are opportunities in the fixed income space, without a doubt. I mean, 10-year yields, as you said, have actually retraced. They came off quite a bit and they're now back to almost a 4% handle. That's because, the investors have, or the markets have taken a view that, perhaps the US economy is not going to fall off the cliff as they were worried about after the employment numbers for July. I think optimism is returning back to the markets, but that could change very quickly. And yields could come down once again, and that could actually be positive for bond markets. So we think there are opportunities in both the equity space as well as the bond space. And what we're telling our clients is to keep a diversified portfolio. It's very important for that. And so we're not negative on either asset class.
When it comes to the equity space, especially Asian stocks, where do you find value at this point?
Well, I think across the board in Asia, there is some value emerging. I mean, the recent sell-off has, created a bit more value. We like the Singapore stock market, for example, because we think valuations are very low. Price to book and price earnings are very, very low. The market offers you pretty attractive dividend yield. We see rotation taking place from the tech sector towards the non-tech sector. And this is where the Singapore stock market is actually quite well positioned. The Japanese stock market is looking interesting as well because in yen terms, since mid-July, the MSCI Japan index has corrected almost 15%. That's a very sharp correction. Now, we remain medium-term positive in Japan. We think that the pullback is going to create opportunities. And, of course, again, not to buy aggressively, but, to accumulate gradually in the markets. China, we know that's a hard one to call, but we are, again, medium-term, long-term positive in China because so much of negative news has been baked in. So something to keep an eye on as well.
Well, so always great to have you with us, Vasu Menon, who's a managing director at OCBC Bank. Take a look at some of the companies that we're watching in the early part of the Australian session. Of course, we're less than 10 minutes into the start of cash trading, but we'll be watching some of these companies on account of earnings. Beach Energy is one of them, JB Hi-Fi. That's always a really interesting gauge of consumer sentiment here in Australia as well, as Horizon and Car Group in focus. Some pretty divergent views there, particularly when it comes to that 8.88% jump in JB Hi-Fi. Broadly, though, we are seeing the potential for weakness when it comes to Australian equities, given that overall the earnings outlook does look a little bit softer as we head into the August reporting season. We've seen analysts trimming those forward earnings expectations by Australia by almost 4% over the past year. In contrast, the Asian peers, of course, have seen a rise. CBA will be the big one to watch this week as well, which kind of sets the scene for the big financial stocks, which are very highly valued at this point, and we'll be getting some of the other updates throughout the course of the month. CBA, of course, is the most heavily weighted stock on the benchmark, and we're seeing that crowded short position beginning to soar. More ahead on the Asia trade. This is Bloomberg.
Chinese property developer Kaisa will square off with creditors on Monday, facing a Hong Kong court that may be open to issuing a wind-up order. For more, we're joined by our China correspondent, Min Lo. Min, so it's been now 2 years after that bond default. Kaisa has still not publicly presented a debt restructuring plan. What's the latest?
Yeah, so this is a very closely watched hearing because it's already been delayed multiple times, and the court has said that Kaisa really doesn't have any excuse this time if it doesn't make any progress. That means if it doesn't present a debt proposal, a debt restructuring proposal, the court could order it to sell its assets to repay creditors. And if that happens, this will be the second largest developer to face liquidation after China Evergrande. And that would deal quite a big blow to the property sector, which is still struggling to find its legs despite the measures that the government has rolled out so far. Kaisa has about $12 billion in offshore debt, and according to a lawyer in the October hearing, its debt recovery ratio is only 5%, even if it faces liquidation. That's because its dollar bonds are trading at cents on the dollar, and that means even if it comes out with a debt to equity restructuring plan, its small market cap will make it quite challenging to absorb a meaningful proportion of its debt.
Times China, which is a Guangzhou-based developer, is also facing a wind-up hearing today. What are we expecting?
Yeah, Times China is just one of over a dozen other property developers that are facing wind-up hearings in Hong Kong. And its case is a little bit more optimistic than Kaisa, given the scale of its debt. It's much smaller. It's only $260 million after it defaulted on $2 notes back in January of last year. Hang Seng Bank had filed this petition in April, and as far as we know, Times China had really been accelerating those talks with creditors, having communication with them and at an almost daily basis at one point. We understand that they have come up with a proposal with 3 options, including a combination of upfront payment, short-term notes, and ordinary shares in the company. Investors also have the option to receive mandatory convertible bonds and medium-term notes as well. So if it's able to show that it's making some progress in its debt restructuring plan, then it may be able to get this hearing adjourned as it finalizes its repayment plan.
Bloomberg's China correspondent Min Lo there will be continuing to discuss China's broad guidelines for monetary, fiscal and property policy easing in just a few minutes. Goldman Sachs chief China economist Shan will be with us. It is a big week ahead for Chinese tech earnings as well. Alibaba, Tencent, JD.com all due to report to give us a fresh snapshot of economic consumer sentiment. Let's bring our reporter Annabelle Jeweler. So we're watching buybacks in particular.
Yeah, well, it's actually shaping up to be a record year for share buybacks for Chinese tech companies, but that theme is going to be really closely watched with these numbers that are due this week. Compelling reasons, of course, for share buybacks to be taking place. You've got the likes of Alibaba, Tencent. They've already been very focused on boosting shareholder returns. You've got balance sheets that are looking pretty strong for these companies. And on top of that, you've got valuations that are looking cheap, especially when you go back to a historical basis. And so as our Bloomberg intelligence team points out, these are sort of the conditions that are very ripe now for share buybacks to be extending. And as I said, those programs are already in place. Tencent, Alibaba, they've already bought back more stock this year, just as we head into 2023, compared to all of, rather 2024, but compared to all of last year, Shery.
Bella, are we going to see that impact of the sluggish economy on those numbers?
Certainly going to be having a bearing and something that really gives us an insight into how Chinese consumers are faring here. But it will, of course, show up in different ways for each company. So Tencent is the first one that's reporting on Wednesday of this week. Here, we're going to be looking at its advertising and its fintech and business services divisions, which make up about 50% of sales. That's what our Bloomberg intelligence team has said would be most at risk if that local economy continues to decelerate. And then as well, you've seen that struggle in retail sales for Chinese consumers for a significant period, even if we saw that pick up in consumer prices in the latest readings. But certainly that picture of retail sales is going to be weighing on the likes of Alibaba and JD.com, which are reporting their numbers on Thursday. Both of those companies have been really pushing to try and lure companies or customers inside China. Obviously, customer acquisition comes at a cost to margins. And then for names like Alibaba, you've seen that high cost of customer acquisition outside of China, especially when you've got competition from the likes of Temu and Shein. So yes, again, that's going to be really telling us how well the Chinese consumer is continuing to recover.
And tech reporter Annabelle Druller's there with those key earnings out of China this week. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how oil is tracking. Of course, we did see that weekly gain last week as traders continue to watch out for the risk of a reprisal from Iran after the assassination of the Hamas leader in Tehran last month. We are seeing the picture a little bit softer at the moment over the past sort of 2 days there, but pretty steady. Under about $80 a barrel is where we've been trading after rising about 4% last week. Iran did reiterate over the weekend that the determination to punish Israel is still very much on foot. Well, the military in Israel says around 30 projectiles were fired from Lebanon towards the area of Kabri in northern Israel, but no injuries have been reported. Israel remains on alert for possible retaliation from Iran or its proxies. Let's get some more now from Michael Heath, our Bloomberg editor, for the latest. So it's sort of wait and see, right? Is it unusual for this to be quite prolonged?
The waiting.
The reprisal, yes.
Yeah, I mean, look, it is, and you sort of this what you just mentioned, the 30 projectiles there, Hezbollah's claimed credit for it, and there's been this ongoing, almost since October 7th, there's been this ongoing tit for tat between Israel and Hezbollah, and they have a threshold that they don't go above. I mean, Hezbollah said it was targeting an Israeli base. Israel says these rockets have fallen into open areas and there's no injuries. But to the wider question about Hezbollah and Iran, when they respond, it is, and you know, it can only work to their advantage in a way, because at some stage, you know, when they keep saying they're going to do this, people were waiting and waiting, and waiting is often the hardest thing to do in these sort of situations. So again, it sort of just plays on the nerves, I guess, of Israel. But again, we have this issue of talks on Thursday coming up, whether they're waiting for that and they don't want to potentially spoil it, or whether that's irrelevant to them. Again, we really don't know. There was also reports that Iran has been doing some missile testing near the border with Iraq. So yeah, there's a bit going on, and it is unusual. They do normally come back reasonably quickly on these sorts of issues.
We also had the airstrike on the school as well.
Yeah, I mean, a terrible situation on Saturday where a school and a mosque next to it were hit, and the Hamas-run authorities say 100 people were killed. Now, they don't distinguish between fighters and civilians, so we're not sure there. Israel insists that it was basically cover for a military gathering of officials, and that it killed some fairly senior people. And again, it comes down to this question of keeping its people in among civilian areas, and Israel then not holding off because it's so determined to try to defeat these guys and win. I mean, sorry, in order to end the war. But the civilian fallout is terrible, and it's just the reality of being in a built-up area like this, that there's always going to be civilian casualties. No matter how precise you are always going to end up with this situation. And this is one of the worst death tolls that we've seen in the war.
Which is why it's really catching the attention of the U.S. Vice President Harris, right? Talking about there being far too many civilian deaths. What have we seen in terms of international reaction, and how has the international community really coalesced around the Middle East crisis right now?
Yeah, Shery, I mean, they were pretty critical of it, and Vice President Harris sort of stuck with the usual US line that you know, Israel has every right to defend itself and target these Hamas leaders, but it just has to be mindful of you know, the civilian fallout, and it just can't keep doing this, and it's only you know, it's fairly isolated internationally in many respects, and it's only asking for more of that when 100 people are killed. Israel would argue that this is just the nature of war, and that you're fighting in a built-up area, and if they're going to win this war, there's going to be civilian fallout. That's just the reality of fighting in such a confined place. But yeah, there has been some quite strong international response, and also a couple of the really right-wing members of Prime Minister Benjamin Netanyahu's cabinet have made some quite extreme response, and the EU mentioned potentially even sanctioning them, which would be really quite extraordinary if members of the Israeli government came under sanctions. So there is frustration internationally, definitely, with these constant you know, large civilian death tolls that come from this sort of activity.
Where's Michael Heath there with the latest on that conflict in the Middle East? As we continue to watch other stories around the world, Ukraine's president says Russian troops have started a fire at an occupied nuclear power plant, calling on the world and the International Atomic Energy Agency to react. Volodymyr Zelensky said in a post on X late on Sunday that radiation levels were within a normal range. Earlier, Zelensky called on allies to allow Kiev to strike deep within Russian territory as Moscow hit back with missile strikes following last week's cross-border incursion by Ukrainian forces. Philippine President Ferdinand Marcos Jr. has blasted actions by China's Air Force against a Philippine plane over the South China Sea as unjustified, illegal, and reckless. That's after a video published by the Inquirer purportedly showed a Chinese plane dropping flares into the path of a Philippine Air Force patrol. The incident happened as the two sides are trying to ease maritime tensions. A new poll from the New York Times and Siena College gives Kamala Harris a 4 percentage point lead over Trump in the swing states of Wisconsin, Pennsylvania, and Michigan. It follows a campaign tour of crucial states by Harris and her running mate Tim Walz. However, the poll also found voters think Donald Trump would do a better job handling the economy and immigration.
Let's take a look at what we're watching when it comes to New Zealand. And of course, we do have that RBNZ decision on tap as well. It seems that the shadow board, at least at this point, are divided over a rate cut in August. This is according to the New Zealand Institute of Economic Research earlier today, saying that division is over whether they should cut the OCR this week, with more than half saying that a 25 basis point decrease is needed now. The remainder is recommending keeping the OCR on hold at 5.5%. But there's overwhelming consensus that an easing cycle in the OCR should commence soon, and several members saying that the RBNZ could actually take a forward-looking approach to these weakening economic conditions. So we do look ahead, Shery, to that decision on August 14th. 12 out of 21 economists expect no change, 9 expecting a cut.
And take a look at how European futures are trading at the moment after we saw most of those losses last week being recovered by the end of the week. This is Bloomberg.
Take a look at how we're faring when it comes to Asian markets. Of course, Japan markets are closed for a public holiday, so a little bit of a holiday quieted start to the week. Quite a bit of caution still as well, even though we've seen some semblance of calm returning to global markets. There's still that sort of sense of a heightened degree of caution. We are seeing some strong gains, though, when it comes to trading the KOSPI by about 1.25%. We're seeing Australia putting on about 0.7%, despite some concerns that broader weakness going into this earnings season is going to see some further downside for Aussie stocks that have been trading pretty close to record highs. Watching CPI this week as we get the start of the big financials and kind of gauging whether these expensive valuations can be justified by the big Australian banks. We're also watching New Zealand as we get into the week of the RBNZ decision. Economists are pretty split as to whether we'll be seeing that hold or the start to the easing cycle, but it is a pretty staid open so far this Monday. A lot of focus on the key US data prints when it comes to inflation and how that really projects expectations for the Fed going forward as well. Hong Kong futures looking a little bit modestly softer at this point, and US equity contracts seeing a little bit of a slippage in the early part of the Asian trade. We're also watching China as well, with domestic activity data due on Thursday. Retail sales expected to show an improvement, but industrial activity is likely to slow. This along with big tech earnings in China as well. Tencent, Alibaba, JD.com will all be quite consequential, Shery, in shaping the expectations for China, particularly when it comes to consumer sentiment.
Yeah, especially in a busy week of economic data, as you mentioned, of course, the activity data, not to mention that the PBOC is also expected to keep interest rates steady, delivered at their usual session. And this at a time when the central bank is also studying a plan to narrow the range of short-term interest rate fluctuations, extending an overhaul of its policy toolkit that aims to guide the market more effectively. Let's discuss this with Shan, Chief China Economist at Goldman Sachs. Shan, great to have you with us. First of all, let's get started started with some of that eco data and PBOC move that we're expecting this week. How are you setting up?
So in terms of what you were mentioning on PBOC, we also received the Q2 monetary policy report. And in terms of assessment on the current economy and big picture on policy moves, very much consistent with what we have been hearing, that support should increase so that the full-year target can be reached. And PBOC also stated to continue lower funding costs for businesses and the households. So altogether, we are forecasting a triple R cut for the third quarter and a 25 basis point triple R cut and 10 basis point cut in policy rate in the fourth quarter. And our rate forecast is predicated on the view that after Fed cutting rate in September, that will open the door for China to continue cut policy rate in the fourth quarter.
Shan, we have seen really these policy moves as well, given what policymakers consider a bond market bubble at this point. Where are you seeing that market headed? Because it seems that when it comes to that quarterly report, the bond market rally was also a concern.
Yeah, there's a box specifically on potential mark-to-market risks if financial institutions and some banks are piling up too much of a government debt. In the event of a spike in interest rate, there could be sort of a risk to be managed. And I think part of the PBOC's focus on managing long-term yield is coming from a risk management perspective. That said, if you look at the bigger trend, if we believe that domestic demand is weak, central bank is cutting rate, then this is just managing the pace of long-term yield decline rather than reversing the long-term yield decline. So if the PBOC continue to cut front-end interest rate, maintaining an upward sloping yield curve which protects bank profitability, then that means the long end of the curve will also gradually coming down. Again, this is just about the pace of decline.
It's interesting, managing the pace of decline versus reversing the longer-term trend. Does that also kind of apply to broader macroeconomic and monetary policy? Because is there a sense that policymakers are kind of comfortable with a level of structural slowdown, knowing that a lot of factors going into it means that they can't reverse it to, hefty levels of GDP growth?
Yeah, yes and no. I think the bigger picture, if I look out for the next 3 years, then that's true, that we are going through structural transformation of the Chinese economy. And in our view, that growth will be slowing down and we're settling at a lower growth rate for China. At the same time, if you look at just this year, right, we already have a growth target set by the government. At this point in time, if you already set a target, then the government would try their very best to achieve that target. If you don't achieve a target you already announced, then there is a credibility and capability issues, then I don't think that's what the government wants to see. So that's why in document after document, you see the statement that we need to increase domestic demand and to achieve a full-year economic targets. So this is a combination of, in the near term, we do think that the government needs to do more, and they are likely to do more on monetary, fiscal, property, consumption, a whole set of policy instruments. But over the medium term, you're correct that we are settling in a lower growth.
Do you worry about a deflationary or stagflationary mindset being entrenched because the moves by the government, by various bodies have been so incremental?
It is the risk. we are seeing the, last week we had CPI ticking up from 0.2% year-on-year to 0.5% year-on-year, but much of that is coming from food price inflation. If you tease out the food, you look at core inflation or services inflation, it's actually declining from June to July. So there is a risk. At the same time, I think this is a balance. I think inflation might stay low, but if you look at, for example, our equity analysts put out a report looking at these sectors with some overcapacity, oversupply issues. At a certain point, if your price is cutting into cost curve, you're also seeing supply responses, whether it's a solar industry, whether it's a battery industry. So I wouldn't extrapolate because if inflation or PPI inflation has been negative or very negative for a while, this is going to continue. There would be up and downs. The bigger picture is that China's manufacturing capability is enormous. Looking at history, it's very hard to see very high sustained inflation. But at the same time, there will be cyclical up and downs. And we are expecting some improvement in the inflation picture, although the risk is to the downside.
We have seen a little bit of concern about a squeeze in the Chinese yuan recently, especially with the strength that we saw over the last week. And yet, given the weakness of the Chinese economy, what will the trajectory of the renminbi be?
It's very interesting when it comes to currency. Currency is all relative. You can imagine a variety of scenarios, right? Our U.S. economists are not expecting U.S. recession, but in the event of a U.S. recession and dollar weakening, then USD-CNY can certainly move lower. At the same time, if we head into U.S. election and if Trump wins the election and imposes a large tariff on China, you can imagine USD-CNY going higher. So we're in a very fluid and uncertain times, and this is where we recommended going short CNY versus a basket, because there, whether it's a tariff scenario, whether it's sort of a dollar weakening scenario, it's likely that the CNY will underperform a basket of currencies rather than expressing a strong view vis-a-vis the USD, just given the range of outcomes possible. But I think the bottom line here is that Chinese domestic demand is weak. PBOC is a cutting rate, and there's a tariff rate risks on the horizon. So all things considered, and taking signal from daily fixes by the PBOC, policymakers do not seem to want to fix the CNY stronger. So that all add up to potentially more depreciation pressure on the RMB versus the appreciation pressure.
Shan, good to have you with us. She's the chief China economist at Goldman Sachs, of course, on a busy week for eco data out of China and PBOC moves as well. And we continue to see those depreciating pressures also on the Japanese yen against global currencies. We're talking about that 147 level against the U.S. dollar. Of course, suffice it to say that you still have to put it into context because we saw incredible weakness on the Japanese yen for the month of July past that 160 level. We're still stronger against the U.S. dollar, around 8% or so. But really, the roller coaster ride for the Japanese yen and the unwinding of yen-funded carry trades has really wreaked havoc across global markets. For more on the yen, let's bring in our executive editor for Asia markets, Paul Dobson. Paul, so how much of this carry trade unwind have we completed, and when can we start breathing more easily in terms of market volatility?
That's definitely the question that everybody's been asking themselves over the weekend, Shery. I think that, if you look at analyst estimates, they're definitely saying that we're closer to the end now. 75% done with JP Morgan's estimate, for example. And I think that there's two things that you have to segregate here, though. One is that sort of speculative trade, and two is the sort of longer-term embedded yen carry trade from Japanese entities, Japanese individuals investing or storing their wealth overseas. So what we've definitely seen is a lot of the speculative trading coming out of the market. If you look at the CFTC data that we saw on Friday as an example of that, we saw a very big scale back, one of the largest that we've seen in recent years, taking that short position a lot lighter. And that sort of is indicative of the idea that we've seen a lot of the retrenchment, a lot of the leverage coming out of the market. On the other hand, I think the retail traders, which is such a big part of Japan's FX market, for example, will continue to hold a lot of their funds in higher yielding assets overseas. A lot of other Japanese entities will continue to hold other overseas bonds and be funding in the yen still as well. And the interest rate differential is still very large as well in any case. So those slower moving funds may still react over days and weeks and months to come. And one way that you can see that is if you look at implied volatility in the currency market, which remains at the elevated levels, not too far off where we hit by the end of the day last Monday when we saw all of that kind of violent moves ahead. So it shows you two things. One, that people are not convinced that the calm is set in yet, and two, that the cost of hedging the yen carry trade is still expensive, and that makes it less appealing and will continue to encourage people to unwind those positions.
What else are we watching out for then?
So I think coming up, there's going to be both US and Japanese data that's going to be pretty important. Remember, it wasn't just what the BOJ did that set off this big carry trade unwind, but it was also that idea that the Fed is going to start cutting rates aggressively that we saw after we got the very low non-farm payrolls figure for the US at the start of the month. And so coming up this week, we have US PPI and CPI figures, which are very important for that Fed pricing, for when we think the Fed is going to start cutting interest rates and how aggressively it might do it. If we see low inflation figures in the US, that will give people more confidence that the Fed could move in September, should weaken the dollar, and therefore may push up the yen again and encourage more of that unwind. Likewise, we get Japanese GDP figures, plenty of attention on consumer strength in Japan in particular. We're looking for some growth finally after what's been pretty stagnant few quarters for Japan. But really, the question is spending continuing? Is that inflationary impulse going to still be there? Then that might determine a little bit more how enthusiastic the BOJ is going to be for further rate hikes through the rest of this cycle as well.
Yeah, we have earnings coming out of China as well, not to mention the PBOC decision on rates, not to mention, of course, economic activity data as well. Anything in particular that you're watching in the Chinese markets?
The Chinese market is so exciting at the moment. The previous guest was talking about this kind of battle between the PBOC and the market in terms of government bond yields. The market continues to mop up those bonds, to be buying them at ever lower yields. You know, the government's funding costs have never been lower, but it doesn't really want that. The PBOC would rather see higher interest rates. It would rather see the yield curve retain some of that steepness. And I think that really what further measures we will see to try to dissuade investors, both domestic and international, from buying those Chinese government bonds over the coming week is going to be really interesting for us to continue to monitor. So keep an eye on that. Keep an eye on shorter term interest rates. Keep an eye on how much borrowing there is going on in the system as well. People taking out leverage in order to do their own version of the carry trade within the Chinese bonds market by borrowing cheaply and buying those longer term bonds. Not much room for that left. And PBOC would rather people weren't doing it at all.
Executive Editor for Asia Markets there, Paul Dobson. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to trading in FX. A pretty quiet start to the week, which could hold still some event risk, in particular when it comes to key data coming out of both the US, Japan, of course, and China. Really watching the CPI numbers out of the Fed, and small bump when it comes to that inflation pickup is unlikely to sort of derail a Fed rate cut, but really watching to see how that's sort of being accepted by markets, if you will, given these expectations at one point for an off-cycle cut of some magnitude. We're also watching, of course, on the flip side, the yen as well. The yen unwinding could take many months to hit fair value. That's according to BNY. And also keeping one eye on emerging market currencies as well. They saw the best week of 2024. Speaking of EMs, the head of India's market regulator has strongly denied allegations from Hindenburg Research of conflicts of interest around investigations into the Adani Group. The short seller published a report on Saturday claiming that the Securities and Exchange Board chief and her husband made investments in products also backed by the brother of billionaire Gautam Adani. Bloomberg's Avril Hong joins us now for more. And Avril, so what do we know? What are each side saying at this point?
Yeah, Heidi. So this is just the latest twist in the Hindenburg-Adani case. And we're hearing over the weekend how Hindenburg published a report, and it alleged that the chief of the Indian market regulator had conflicts of interest which prevented a thorough investigation into the 2023 report from Hindenburg, which alleged fraud as well as market manipulation by Adani Group. And of course, we all know what happened in the wake of that. About $150 billion of market value wiped out in the Adani Group. Now, the latest report over the weekend from Hindenburg actually says that the market chief, the market regulator chief, along with her husband, had investments in foreign entities, and they're alleged to be part of a fund structure that is linked to Vinod Adani. This is Gautam Adani's brother, and it's basing this off whistleblower as well as reports that Bloomberg has not yet been able to verify. As to what both sides are saying, the market regulator chief has strongly denied these allegations, calling them insinuations, calling them baseless. We also had Adani Group coming out in reaction to this, saying that they are recycling of discredited claims, and this is what we know so far.
Yeah, those allegations against Madame Puri-Bush by Hindenburg, how unusual is it that a short seller calls out the chief of a markets regulator?
Shery, it is highly unregular. I mean, we have seen some of these short sellers in the crosshairs of regulators from the US to even in South Korea recently. But for a short selling firm to actually directly, publicly call out the chief of an overseas market regulator over ethical violations is something that is highly irregular. And this is, I think, after weeks of the escalation in the face-off between what we're seeing between Hindenburg as well as the Indian markets regulator. Basically, Sebi has not come out yet with a case against Adani, but it has asked for further information between Sebi to get further information from Hindenburg, to get further information from Adani Group. And it says that, you know, some of the investigations against Adani Group, 23 out of 24, have been completed so far, but the investigations into Hindenburg are also still underway. So this is following on from it actually querying Hindenburg for more information. Shery.
Yep. Bloomberg's Avril Hong there with the latest. More ahead on the Asia trade. This is Bloomberg. And Heidi, we're headed towards China Open. And of course, we've talked always about this market as sort of an anchor for emerging market stocks, given its weighting when it comes to the EM index on the MSCI index. We're talking about a weighting of more than 22% or so for China. India has always lagged behind at around that 19.99%. You can see on that chart. But then India is very much closing in on China's weighting. And now we have some analysts expecting it to actually catch up after the index providers review this week.
Yeah, it would likely, of course, just drive further flows into the Indian market. Of course, fund managers saying that the rising heft of India could have a number of different ways of impacting this broader EM complex, right, including making being engaged as broadly more appealing, particularly in light of some of the declines that we've seen in the Chinese market, and sort of lure back those global investors who've been so wary due to China's sway over the index. It can make it more balanced. Secular growth stories like India receiving higher allocation could see some of these sort of upside effects as well. There's also a side effects as well, where index followers could be forced to allocate their funds to India's already expensive stocks at a time when crowded trades are taking a hit as a result of the turmoil and the selling that we've seen in global markets. So it'll be quite interesting in terms of how this plays out. We have seen this as a pretty gradual process. So China's standing in the EM space has really shrunk over the past few years. Back in 2020, China accounted for 40% of the MSCI EM index. That weighting has now dropped. Of course, a lot of Beijing's regulatory crackdowns and efforts to deleverage the property sector has also played a role as well. But take a look at how we're setting up for some of the other markets set to come online over the next hour or so. And taking a look at US futures in particular, of course, it has been kind of a mixed session in terms of just some of the fragility that is still in these markets after last week's sellout. Just a week ago when everything was sort of coming unravelled. US futures looking pretty muted at this point. We're seeing TAIEX futures looking like will advance along with a number of the other markets that are seeing gains so far this Monday morning. A50 China futures there. We're waiting for the PBOC as well as domestic activity data out of China this week, a little bit softer at 0.25% lower. That's it for the Asia trade. The China show is next.